There is a line under the silver market at $57 an ounce. It has held for months. Every time silver has fallen to it, buyers have shown up and pushed it back. It's the floor of the entire range. And right now, that line is starting to crack. Silver's coiled into what the chartists call a symmetrical triangle. The swings getting smaller, the range getting tighter, pressure building. And it is sitting right on top of that floor, looking tired. The lines are drawn and they're not ambiguous. A break above 61 and this thing runs. A break below 55.71 and the floor gives way. Now, most people hear that and think it's chart astrology. It isn't. I'm going to show you exactly what a support level actually is, not the mysticism, the mechanics. Because when you understand what's physically sitting underneath $57, you'll understand why these levels break the way they do, slowly, then all at once, and why the break itself has almost nothing to do with whether silver is worth owning. Let me show you what's really happening. Because there is a version of the next few weeks where you get shaken out at the worst possible price by something that has nothing whatsoever to do with silver. And the only defense against it is understanding the machinery before it runs. Forget lines on a chart, and forget the mysticism that surrounds them. A support level is not magic. A support level is a memory. It's a place on the map where a very large number of human beings made the same decision at the same time, and every one of them remembers it. Here's what's actually stacked at $57. There are people who bought there and are barely break even, promising themselves they'll get out at cost if it comes back. There are traders holding leveraged positions whose brokers will forcibly liquidate them at a specific number. There are funds with a written rule that says exit if it closes below the range. And there are patient buyers with resting orders sitting just underneath, waiting to catch it. That's the floor. It's not a line, it's a pile of promises. And promises, unlike metal, can be withdrawn in a heartbeat by anyone who changes their mind. Which is why a level that looks like bedrock on a chart is really just a crowd standing in one place. And crowds move. And here's the thing that makes it fragile. Every single time the price tests that level, some of those buyers get used up. They fill their orders. They're done. Their money's spent. So the fourth test of a level is not the same as the first test. It looks identical on the chart, but underneath, the pile of buyers is thinner every time. The line looks like it's holding. What's actually happening is that the defense is being eaten alive. That's what starting to crack means. Not that a line got touched, that the buyers behind it are nearly gone. Now, let me pause for just a second, because if any of this is making you look at your own retirement accounts differently, that's exactly the right instinct. I've put together a free guide that walks through how retirees are protecting their savings in exactly this kind of environment. It's completely free. The link's in the description, or just scan the QR code on your screen. Takes 2 seconds. All right, now let me show you what happens if 55.71 actually goes. This is the part I want you to understand, because it's the thing that scares people out of the market permanently, and almost nobody explains it. If that level breaks, silver does not drift lower. It falls in an elevator. Here's why. All those stop-loss orders I just described, they're not spread out. They're clustered, bunched just below the obvious line, because everyone drew the same line. So when price breaks through, it doesn't hit one seller. It hits a wall of them, all at once, automatically. And every one of those sales pushes the price down further, which triggers the next batch of stops, which pushes it down further, which triggers the next. That's a cascade. It's mechanical. There's no human deciding silver is worth less. It's software selling because a number was crossed, forcing more software to sell because a lower number was crossed. And silver is uniquely vulnerable to it. It's a small market, thinly traded, heavily leveraged. The same force that gives gold a 20% correction gives silver a 52% bloodbath, which is exactly what already happened, from over $121 an ounce down to 57. That's silver's nature. It overshoots in both directions. Everyone remembers that on the way up and forgets it on the way down. So yes, if 55.71 goes, there is air underneath. I'm not going to pretend otherwise. And it will happen faster than you can react to it, because the whole point of a cascade is that it does not wait for anybody to think. Now, here's the question that actually matters for your retirement, and it's the one nobody asks. Does any of that have anything to do with what silver is worth? Because look closely at what I just described to you. Margin calls, stop-loss orders, fund mandates, software triggering software. Not a single one of those has an opinion about silver. Not one of them is a judgment about supply or demand or scarcity or money. A leveraged trader getting liquidated at 3 in the afternoon isn't thinking about mine output. He's thinking about his account balance. Meanwhile, in the physical world, the world is 6 straight years into a structural silver deficit. 6 consecutive years of consuming more silver than gets produced, plugging the gap out of finite above-ground stockpiles that took decades to build. That deficit didn't close while the price got cut in half. If anything, it got worse, because silver gets destroyed, consumed. It goes into solar panels, electronics, medical equipment in amounts too small per unit to ever economically recover, and it ends up in a landfill, permanently. Silver is the only major monetary metal whose above-ground supply actually shrinks. So you have two completely different markets wearing the same name. There's the paper market, futures contracts, most of which never move a single ounce anywhere, where the price is set by leverage and interest rate expectations. And there's the metal, where the shortage is real and getting worse. A cascade below 55.71 would be an event in the first market. It would tell you precisely nothing about the second. And that brings me to something that matters, especially if you're sitting on $100,000 or more in a retirement account, a 401k, an IRA, anything like that. Because this is exactly the kind of environment where the decisions you make actually count. I put together a free retirement protection guide that covers the strategies retirees are using right now, including how some are moving a portion of their retirement savings into physical metal without triggering taxes or penalties inside the tax-advantaged account they already have. It walks through it step by step, in plain English, and covers the mistakes that cost people real money. It's in the description, or scan the QR code on your screen. And if you go through the guide and want to go deeper, there's a free, no-obligation, one-on-one educational session available for folks with $100,000 or more in any retirement account. Just answers, no pressure, nothing to buy. Okay, back to the floor. And here is the detail that tells you how thin the defense has already gotten. Not long ago, the most aggressive physical buyers on Earth were Chinese, paying premiums of 12 to 13% over the world price just to get their hands on actual metal, importing roughly 790 tons of silver in the space of 2 months, 470 tons in a single month. That was a bid underneath this market that never showed up on a chart. And now, that market has flipped to a discount and gone quiet. The reason they gave was not a change of view on silver. It was that they are afraid the price will fall further and are waiting through a clearer picture. They paid a 13% premium near the top and will not pay the asking price near the bottom. That is what removed a chunk of the floor. Not a judgment about the metal, a retail buyer doing what retail buyers have done in every market since markets existed. And it is worth saying plainly, that makes the near-term crack more likely, not less. When the marginal physical bid steps aside, the paper market gets to set the price unopposed for a while. But notice which buyer did not step aside. The official sector. The institutions that manage the reserves of entire nations never paused. They kept taking delivery of physical metal at a generational pace. They are not price sensitive the way a shopkeeper is, because they are not buying a trade. They are buying insurance against a currency. And insurance does not become less necessary because it went on sale. Now let me tell you why the floor is under pressure in the first place, because it has nothing to do with silver. The Federal Reserve, under Chairman Kevin Warsh, has gone hard hawkish. The market is now pricing roughly a 65% chance of a rate hike. A hike, not a cut. The odds of a cut have collapsed to about 2%. Nearly half the committee wants at least one hike before the year's out. A third want 2 or more. The minutes showed them split 9 to 8. 1 vote. Silver pays you nothing. No interest, no dividend, no coupon. So its permanent competitor is a bond that does pay. When the market prices a tighter Fed, yields rise, the dollar rises, and everything paying 0 gets sold. That's the weight pressing down on $57. It's not a silver story. It's an American interest rate story, and silver is downstream of it. Which means the floor doesn't break because silver got worse. The floor breaks because a committee in Washington might do something in a few months. Let me show you the history, because there's a story here that every silver holder should know, and it's the most important cautionary tale in this metal. Years ago, 2 Texas oil heirs reached the same conclusion a lot of thoughtful people reach, that paper silver was a fiction and the metal was real. So they did what almost nobody does. They started taking delivery, actual bars. As the metal drained out of the system, the price went vertical, running toward $50 an ounce in a market where it had been a few dollars. The paper claims were being called in, and the system was staring at the possibility that it couldn't deliver. And then they lost everything. But here's the part everyone gets wrong. They did not lose because they were wrong about the scarcity. They were right about the scarcity, completely right. They lost because the exchange changed the rules on them mid-game, restricting buying to liquidation only. In one stroke, the people who had written the paper rewrote the rulebook to protect themselves. And once that happened, the price didn't care what the metal was worth. It cared what the rules said. Sit with that lesson, because it is uncomfortable. It cuts both ways, and almost nobody who quotes that story has ever actually understood the ending. Being right about a physical shortage does not save you if what you're holding is a promise. The system protects the system. If you own a claim, you're a creditor, and creditors get whatever's left after the rules get rewritten. That's why the distinction between the paper and the metal isn't academic. It's the whole thing. It is the difference between owning silver and owning an argument about silver. And there is a reason this metal is built to break levels harder than anything else, which is worth understanding before you watch it happen. Most silver is not even mined by silver miners. The large majority comes out of the ground as a byproduct, while somebody digs for copper, lead, or zinc. It is loose change in their pocket. So if silver doubles, that copper mine does not dig faster. It digs on the copper price, which means supply is almost completely deaf to price. Meanwhile, the people who need silver cannot say no. There is no substitute at the same performance in a solar panel or a circuit board, and a few dollars of metal in a device selling for hundreds is a rounding error to the manufacturer. Put those together: supply that cannot respond, demand that cannot refuse. When you have both, price is the only variable left that can move, which is exactly why this metal travels in violent, disorderly leaps in both directions. The same physics that just took it from 121 to 57 is the physics that takes it back, and it will not be gradual either. Now, let me be honest about the risk, because I'm not interested in selling you a fantasy. 5571 could go. If it does, this could get uglier before it turns, and a 6-year deficit puts no floor under any particular Tuesday. Scarcity sets the destination. Interest rates set the timing. Anyone who tells you the shortage means silver can't fall further is lying to you. It just fell in half while the shortage was running. Nobody can give you the day or the hour, and anyone who does is selling something. But here's the asymmetry that matters at your age. A cascade is a liquidity event, not a valuation event. It's forced sellers meeting an empty order book. And forced selling has one universal property: it ends. It ends because the forced sellers run out of things to sell. That's it. There's no lasting information in it. Meanwhile, the shortage doesn't run out. It compounds every year, permanently. And here's the part that should genuinely worry you. And it isn't the price. It's what a break does to you. Because a cascade is engineered, almost perfectly, to make you quit. It's fast, it's violent, and it arrives with a wall of headlines confirming that you were a fool. Everything in your gut screams to get out with what's left. And selling into a forced liquidation cascade at the bottom after a 52% decline because software hit a number is the single most reliable way ordinary people turn a temporary drawdown into a permanent, unrecoverable loss. If you're 30, that's tuition. If you're at or near retirement and drawing on these accounts, that's the rest of your life. And there is one more thing worth holding on to about levels like this. A support level that breaks does not vanish. It flips. The same pile of memories that acted as a floor becomes the ceiling on the way back, because everyone who got hurt there is waiting to get out at break even. Which means if 5571 goes, the recovery has to fight its way back through every person who swore they would sell the moment they were whole again. That sounds bearish. It is for a trader, but understand what it means for someone with a decade-long horizon. The metal changes hands. It moves from people who bought a price and got hurt to people who wanted the metal and did not care about the price. Every one of those forced sales permanently transfers an ounce from an impatient owner to a patient one. And when the rate environment finally turns, all that metal is sitting in hands that will not sell it back cheaply, which is precisely why the recoveries in this metal are so violent. There is nothing left in the float. So here's where I'll leave you. Yes, the floor is cracking. Yes, it might break. And if it does, it'll be fast and it'll be loud and it'll feel like the end of the argument. but understand what you'll actually be watching. A pile of promises giving way, triggering software to sell to other software in a market where the metal barely moves. The shortage will still be there the next morning. The solar panels will still need silver. The mines still won't exist for another decade. The only thing that will have changed is who owns it. If today raised more questions than it answered about your own savings, that free retirement protection guide is still in the description, and the QR code's on your screen one more time. It costs you nothing to be informed, and being informed is the entire difference between watching a cascade and being liquidated by one. And for those of you who stuck with me all the way to the end, here's something just for you. If you have $100,000 or more in any retirement account, and you mention that you watched this full video, you can claim a free, one-on-one, no-obligation educational web conference. A real conversation about your specific situation, with no pressure and nothing to buy. That's only for folks at that level who made it all the way here, and you're one of them. Scan the QR code, grab the guide, and take the first step toward protecting what you spent a lifetime building. Because $57 isn't a floor, it's a crowd. And crowds always leave right before the thing they were waiting for finally shows up.